All right, guys. Hello, hello, hello. How's everyone doing today?
Doing good.
I'm good.
Good, good, Faith. Appreciate that. Jen, good to see you. Don, John, great
Hey,
group of people here. Hey,
Leslie's
guys.
here
Hey,
too.
Leslie. Good, wonderful. I appreciate that. Good. All right. I feel like economic update is always like Christmas morning for me. We get to unwrap all the goodies that are going on. So, of course, we do this series every month so that you are equipped with just a primer on what's happening in the market. How do you use the data to then explain to your clients how to buy and how to sell and how to more efficiently meet their goals? And of course, in the MREA, Gary says, be the local economist of choice. So our goal is to interpret what's happening in the economy so that you can understand the impact on mortgage rates, so that you can understand what that means for our inventory. And we've got some really fascinating inventory. Your clients also hear a lot of what's going on in the news, and of course, we have a lot of of presidential policy that is impacting the housing market, and it's moving at a breakneck speed some days. So there's just a lot happening. So we're going to let everyone get in here, and looks like we've got just about everyone in at the moment, and we will get started. Okay, let me pull up my first slide here. Okay, and we're off to the races. Before we get started, I do want to just share one little quick update for you. Of course, I'm the OP for KW Coastal Living 1 and 2, Inglewood and Sarasota Lakewood Ranch. This is our really exciting announcement that is incorporated into this. We do have our internal mortgage company that is launching this month, and we are literally like 2 days away from being able to announce the leader who is going to be leading this. I'm very excited for you to meet that individual. He's been very quietly lurking around, and so when we introduce him, you may actually recognize who he is. And what's important to know about this is that we are integrating mortgage into our brokerage operation to be able to give your consumers a one-stop shop experience. And it does two things. One, it lets us better align the value proposition and the experience for the customer in a way that you have more control over that. And two, it also creates economic opportunities for you as an agent, in that once this is up and going, you will have the opportunity as a KW Coastal Living agent to actually become an investor and an owner in this mortgage company. And we're doing it for the express purpose of bringing passive income and wealth building opportunities to our agents. So we're super excited about it. Just like Command is the technology platform that Keller Williams runs on, Echelon runs on a technology platform that when you see it, when we've introduced it to agents, they love it. They love the fact that there's so many things you can do. And one of the really nice parts of the technology is that it actually will go out and look for the best prices for your client and will bring them back multiple offers. So rather than going to one place and getting one offer, your clients will get the best of two or three offers to be able to select from. So watch your calendars. We're going to be launching the week of the 17th. We will have a big launch event. So we'll have a big party that'll let you meet the team, meet the people, and learn everything about it. And I just encourage you to be curious. And we look forward to being in business with you in a mortgage operation. So diving into the economic factors this month, it's a whole bunch of them. The best way to summarize what we're dealing with is, if it's good for the US economy right now, it's bad for housing. And I know that sounds like a weird way to say things, but all of the good news that's been out there has actually been challenging for the housing industry. And we are now 4 calendar years into the lowest sales pace in US history when you adjust for population growth. So when we were teaching KWA in the Lakewood Ranch office the other day, I said, if it feels hard, it's because this is literally one of the hardest markets, even in excess of 2008. This is one of the hardest markets to be selling in. So weather the storm, stay close to your database. And on the other side of this, we're setting up for a really, really fantastic, probably 4 to 7 year run. So we just have to make it through this tough time. So some of the topics we're going to touch on today are going to be the impact of tariffs, and tariffs are driving just some inflationary concerns and causing some weird, funky consumer and investor sentiment. And if you guys have been watching your 401ks or watching the stock market, you know, one day it's up and then it's a head turning shift and then it's up and then it's down and back and forth. That concern and that sentiment is driving that stock market volatility, which when the stock markets become volatile, that means the bond markets become volatile. So that's caused the 10-year treasury to stay in an elevated position over where we would expect to see it at. Now, it's not that it's terrible right now. It's just that the spreads are not where we would like them to be. So we're going to touch on that. And then, of course, we do have some other things. We've got a Supreme Court ruling that's going to kind of probably positively impacted the market on the Federal Reserve. And in that Fed policy update, we did have a Fed meeting this month. We're going to talk about what was announced, but they did decide to leave rates unchanged. And this is a little bit of a point of contention with the Trump administration. They really want to see rates coming down because it will help with the impact of the tariffs. And yet Jerome Powell has remained very steadfast that he's not going to make a move. So I kind of liken what's been happening with Jerome Powell and the president as he's kind of roughing the ref a little bit. He's kind of, getting in his face and trying to exert pressure. Inflation has been cooling, but the tariffs will probably bring some of that inflation rate back up. And that's part of the reason the Fed's been so reluctant to really make any moves. Unemployment remains low. In fact, we're pretty much at maximum employment right now. We also just yesterday had a really important court ruling on the tariffs, and it's going to be kind of interesting to see how that plays out. And we'll talk to you about what that means. And then two other things that we're watching closely. And when I say we, it's me, it's the economists that I follow, it's just the circles that I talk in. We're seeing some builder confidence really starting to wane a little bit. And some of that is just we're coming off some really good years. In fact, we may have seen kind of the peak housing starts. In other words, new construction we may see the last 5 years of this decade kind of be somewhere where we are right now instead of where we were in that 2021, 22 timeframe. And that's really indicated by the fact that those new housing permits are actually back to recessionary lows. So the new housing starts are just they're very careful. And builders, of course, they are able to control their own market, and they're able to especially the large scale builders to offer financing incentives that can keep their inventory moving, where the existing inventory sometimes a little harder to compete with that. So let's talk about tariffs. One of the economists I follow calls them the Godzilla tariffs. And these were just massive tariffs that were put into place. And here's the reason these really happened. Let me move this off my screen here a little bit. March of 2025, the trade deficit, so the what we bring into the country versus what we send out of the country, hit a record of almost 141 billion. And it was up even from February of 123 billion. Now, when you go year over year, that's a 105% increase over the year. So last year at this time, we were sitting at about 68 billion of trade deficit. The challenge with that is we're sending money out of the country, but the money is not coming back into the country. And that affects both our money supply, that affects how the strength of the dollar. And the Trump administration in his first term really took a strong position on this and did do kind of baby tariffs back then. We called it the tariff tap dance. He's really looking to try to return to that made in the USA and return some of that production back here. Now, in the first administration, he waited until interest rates were low, inflation was low, and the economy could absorb some of the impact of that. So while in his first term, the business investment did actually slow down significantly as a result of the tariffs, we didn't feel the impact of it. However, we're in a high rate environment. We're in a slow sales pace, and the housing market is a huge sector of our economy. So right now, it's a little bit of he's having a challenge. He had to do this early enough in his administration so that he had the time for it to play out. But his hands forced just a little bit on this. So we do have a goods deficit. So the amount of goods is sitting at 163 billion, and our services, we actually have a services surplus. So we actually sell more services to the rest of the world than we buy from them. But that difference is still, 140 billion. So here's what he did. He put a universal tariff on all imported goods. And this was what we called the April 2nd Liberation Day announcement. Those went into effect April 5th. And it applies to all imported goods, including construction materials and appliances. And this is where I'm sharing this with you so that you have a perspective with your clients when they ask you, how are these tariffs going to impact us? You've got a little bit of background. Now, in this case, construction materials, appliances, these are all directly related to housing. And it is expected to kind of broadly increase the costs across the housing sector. And here's what some of them look like. We have a steel and aluminum tariff right now of 25%. They went into effect March the 12th, and it applies to just about everything that virtually all sources, and it reverses a whole bunch of prior exemptions that were in place. The result is it's increasing the cost for structural steel, appliances, and all fixtures. So we do see prices going up, and this is where the Fed's concerned about seeing additional inflation later this year. So that's the steel and aluminum imports. This one directly impacts much of the US. The Canadian softwood lumber tariffs are at 14.5%. They may go up to almost 35% later in 2025. There's still some discussion at the Commerce Department of how that would look. But currently, Canada supplies 85% of the U.S. softwood lumber imports. So that's a pretty big chunk of the marketplace. And it accounts for 30% of the total U.S. consumption. So if you think about all the wood and the materials, I remember I had to sell a home, or I sold a property during COVID, and the roof that would have been pre-COVID pricing probably would have been like 16,000, and the roof was, because it needed a lot of wood sheeting on it, the roof was, I forget, something like 29,000. We're kind of seeing that same cost increase right now. So tariffs are raising framing and finishing costs in home buyers, and this is going to eat into builder revenues, and it's going to also just push some prices up over the short term. Now we'll talk about how this likely will play out in a moment. Of course, we have the Chinese goods tariffs that went into place. That one, the initial rate was what we call the Godzilla tariff of 145%. That was adjusted down to 30% in May, and that gave them a little bit of a cooling off period to try to negotiate. We talked about this a little bit last month, but the Chinese economy is very weak right now, so we can weather that storm, but it's a little harder for them. It creates a much bigger impact. They have high inflation and they have high unemployment rates currently. So this does apply to all Chinese goods, including building materials and appliances, and will temporarily increase the cost of those imported construction materials. So again, that's a big one. Solar is also on the list of things that are specific to this tariff. So the solar market is impacting a little bit of what we're impacting, or what we're seeing in the housing market. So overall, here's what's happened. We do have rising construction costs, structural components, lumber, increasing framing and finishing costs, and appliances and fixtures. All of this goes right straight into the cost of a house. So think about that. Now, yesterday we had a really big ruling from the U.S. Court of International Trade, and they ruled that the April 2nd tariffs exceeded Trump's authority under the International Emergency Economic Powers Act, and that's the tool that he used to put these in place. That's going to block most of the administration's tariffs orders issued since January. And this just happened yesterday. So I don't have a tremendous amount of commentary yet on this, but it's kind of interesting because it's a challenge for the administration in that it delays their process and could be a setback for the administration. Now, the Trump administration has filed an appeal, and we're going to watch that real closely because however that appeal goes will probably affect both future trade policy of like this year, future presidents, but it also will probably have an impact on the housing sector. So we're just watching that real closely. It's important to note that while it affects all the broad tariffs, the sector-specific tariffs, they're still in place. That doesn't change. We also had some talk this last month about Trump's desire to fire Jerome Powell. And of course, he put Jerome into his position in his first administration, and they pretty much have not seen eye to eye since that moment. So on May 22nd, the Supreme Court ruled that the president could remove certain federal officials, but not the Fed. They ruled that it was its own quasi-independent arm of the government, and it was uniquely structured quasi-private entity. So Trump is really looking to push the federal funds rate down so that it would spur housing, it would blunt some of those tariff costs, and it would keep the economy humming even against the backdrop of the tariffs. And the interesting part is even if you saw a 0.5 to 1% reduction in the federal funds rate, it would have a massive impact on our housing market. I mean, we would go from a stalled environment to something moving very fast, very quickly. So we'll watch that closely. I put the comment on here, shadow Fed, and this is a concept that since Jerome Powell's term ends next year, if the Trump administration were to say, hey, here's who we are going to replace Jerome with at that time, and that individual were to start talking about what his or her plans would be, that would be an indication that it would almost trump Jerome Powell's commentary and would potentially move the market. So that's been floated. I don't know if that's really going to happen, but that is something that if he can't rough the rough, then the shadow Fed model would be a way to get those rates or get some commentary out into the marketplace. So if we look at just where treasuries have been, of course, the 10-year treasury is what impacts our 30-year mortgage rates. And it has been an absolute roller coaster of the last 30 days. We've gone anywhere from a low of 3.9% to as high as 4.6%. 3.9 is a little bit of a key technical level. When you get below 3.8, 3.9, usually you have rising unemployment. You usually have a slowing GDP. So that's a level we tend to bump up against and we don't always push through. All this is driven by investor reaction on the trade war, the state of the economy. And again, as I mentioned, the investments, businesses are pulling back on their investments. They're not sure what's going to happen. So they're careful with their dollars right now. We look at this in a graphic form, and you guys are seeing my screen, right? Got a thumbs up? Okay, cool. If we look at this in graphic form, you'll see where the market was on April 2nd and the plummet that happened between April 2nd and the 4th. And that was the stock market going up, the flight into bonds, and the yield going down. Since then, we've been up and down. May 21st, just last week, we had our high of 4.6, and we're sitting at 4.48 today. Now, if we look back at this on, let's see, this is the 6 months. So we have 6 months. This is also where, so I noted that this is also where the ruling came in. So that's affecting this just a little bit. We look at 30-year fixed rates. What's the impact that's having? So we have unfortunately been riding in a trough between about 6.75% and a little over 7%. And if I'm being honest, this is kind of that watched pot that just will not boil. We've been looking at this since last September, June, July, August timeframe. We saw some rate reductions. Kind of felt like by the end of the year, we were going to be back into the low to mid sixes. And then here we are. It just won't move. We are at the highest level in 3 months and slightly lower than 1 year ago. However, there is some good news in here, and I'll show you what that looks like. So if we look at the trend of our 30-year fixed rates, you can see January 16th, 2025, we had a high of a little over 7%. The source for this particular item averages the average for the week. And in this previous slide, I was actually using the Mortgage News daily, the daily average. So you get the idea of the trend where we hit some highs, we hit some lows, and now we are still headed back up, wrong direction. But here's the favorable information that we're seeing in this. There's a survey called the Mortgage Purchase Application Index, and this is one we haven't talked about in this call before, and it measures relative to rates, what is mortgage purchase activity? And we've had about 13, 14 weeks in a row of sustained growth in mortgage purchase applications. And these are just in purchases, and these are actually in resale purchases. So this isn't the new construction number. This isn't the refinance number. This is just new construction. I'm sorry, this is just existing inventory. April of 2024, rates were 7.1%. May of 2025, mortgage purchase application demand is up 18% over the same period last year. So people are getting a little bit more accustomed to the higher rates. They're back against the wall in terms of really needing to make a move and recognizing that rates will probably fall somewhere in the next year or 2 years. So if they can afford the payment, it's not a bad day to lock in a price that can be negotiated down, knowing that in a year or two they can refinance out of that. But this is an indicator that this year's spring home buying market is not the dud that we were worried about. And I know in Florida we have a little bit of a reverse. We're talking about some national numbers here, but we're actually experiencing a pretty good season at this point. The challenge is we're probably not going to see rates go much lower unless we see labor data breaking, and the particularly the multifamily 4-unit or 5-unit and above construction markets. There's a lot of those projects coming to an end, and in this high rate environment, that presents the possibility that we'll see some of those construction workers going into layoff, and that's the one thing that would push that labor data higher. Okay, if we take a look at this, trying to get this out of my way here. It is in my screen. Okay, good. If we take a look at this purchase index, this gives you the 1 year, a picture of the last 1 year of what's happened. So the survey is currently at 157.8 now. Last year we were at 138.4, and the gold line indicates the mortgage rates. And you'll notice that, for instance, mortgage demands remain fairly steady, but you can see as rates dip, you do see an increase in that demand. Now, here's the interesting part. When you take a look at this exact same concept, but we go back to a 10-year level, you can really see our challenge and what we're feeling in this market right now. Of course, in 2020, we had the COVID pandemic hit, and you saw this massive pullback in applications, and then everyone realized if you're going to be at home, you might as well live somewhere you want to live, and rates hit 2.5%, and the market just accelerated. And so we hit our high January the 11th, 2021 on the mortgage purchase index. And you can see June 2022, that's when everything just turned. And we've been in that deficit position since then. So the one thing that I know to be true on this is the last 3 calendar years, we've had somewhere between 1.2 and 1.7 million home sales. So those are existing home sales that should have occurred. And those are people who got married, who got divorced, who had a child, and they're looking to move into their first home, first-time home buyers, all of those life events. So while pent-up demand is sometimes a misnomer, we really do have a tremendous number of transactions that are sitting out there waiting to happen. And to being truthful, if we can get those rates anywhere into the 6.5, 6.25, get that closer to 6, which would mean spreads would get a little bit better, and I'll show you what that looks like right now, and probably a little tiny bit of weaker economic data, we're off to the races. As it is, we're stalled in this pattern. And yet, as I said, we are seeing buyers coming off the sidelines. So as it relates to mortgage spreads, 10-year treasury yesterday was sitting at 4.47. 30-year fixed was at 6.99. That means the spread or the difference between the 10-year and the 30-year is about 2.52%. At the worst, during COVID, we had a 3% spread. However, typically we're going to see somewhere between about 1.5% and 2%. So 1.7 is actually the last, I believe it's about a 30-year average. So if the bond market settled down and the sentiment of those bond investors could just kind of settle, that alone could bring our rates down to somewhere in the 6 1/8, 6 1/4, 6.5 range. And that would be enough to spur activity as long as we can get it lower for longer. So watch this very closely. And I think that we're going to, fingers crossed, the next probably, I'm going to say probably 90 to 3 months to 6 months, maybe our turning point. It's very possible that the second half of this year will be very different than the first half of this year, is what I'm trying to say. Now, June 2023, I noted the spreads are at 3%. So we'd actually be at 7.5% today if we were at the worst of the spread. So at least we're not there. That's the positive news. This is a chart that reflects what I kind of called the slow dance between that 10-year treasury and the 30-year fixed rate. And the reason I show this slide is when your consumers ask, wait, the Fed cut interest rates, but mortgage rates didn't drop. The reason for that is that federal policy only makes up about maybe 65% of the influence on the actual mortgage rate. And so if you kind of follow this line, the gray line here is the federal funds rate. And of course, in this period of time between 2022 and 2023, this was the fastest increase in the federal funds rate since the 1980s. So, I mean, it was fast. We went up. You can kind of see where, almost like a heartbeat, the blue line, which is the 30-year fixed rate, and the red line, which is the 10-year treasury, they just kind of dance together. They follow each other's pathway. So helping your consumers to understand that when the Fed talks about rate cuts, yes, that can influence rates, but not as much as some other factors. So when we look at this, we do need, as I said, softer economic data. And right now the Fed has made it really clear that they're looking at labor data over inflation data, meaning if the labor data softens, that's when they'll make a move. But if the inflation goes up, they may not be, even if inflation comes down, I should say, they may not be as apt to do something. We talked about demand. U.S. building permits. This is a really fascinating item, and I touched on this at the top. We are down 4% to a seasonally adjusted annualized rate of 1.422 million. Now, this is the lowest level in 11 months, and this is an indicator that builders are starting to pull back on construction activity. They're selling off their existing inventory that's out there, but they're not starting as many homes as they were. In fact, when we look at this, we're back to pandemic lows, and mortgage rates and tariffs are really driving this a little bit. When you look at this, this is a 5-year history. And this is the 5-year history of U.S. building permits. And you can kind of see we hit that 2022 range. We were flying high on new construction permits during that period of time. And all of those housing starts now are starting to close out. And we are back to where we were in July of 2020. Which was, towards the start of COVID. So building permits are dropping, and we're going to watch that closely because that's a big sector. A couple of other things. As I said, the Fed did not change the federal funds rate. So they are causation, not correlation. I touched on that a little bit. In the last meeting, the May meeting, the Federal Open Market Committee said, hey, we're going to leave things steady. They did cite a couple of statements. They cited unemployment risks, and they expressed concerns about rising inflation due to the tariffs and a potential increase in unemployment, indicating a changing economic environment. The Fed earlier this year did set its projection for unemployment at 4.4%. And that's pretty much where we're running right now. So we're still in line. One of the concerns that they did talk about is they did discuss the risk of stagflation, and that's where you get a stagnant economy with very high inflation, and that can really impact. That can have a long-lasting impact on the economy. And many of you remember, if you were around in the '70s, we experienced that in the '70s, and it was a little bit of a challenge. So it took a lot of years to recover. Inflation, we're sitting at about 2.3, 2.4%. And so if we look at this, you can kind of see we've moderated. So inflation is under control. The Fed has two mandates: to keep employment at maximum employment and keep inflation near 2%. And those are they're what we call the dual mandate. So right now, they're doing their job. They're keeping it there. It's just not good for housing. And of course, if we look back, we all remember the pandemic, the supply and the demand shock that created that, with a lot of fiscal policy, created some very high inflation. And you can kind of see we had that high in that May, June 2022 timeframe. And of course, that's when those rate cuts change. So again, I think this is a good one to have in your listing portfolio to be able to look at. We look at unemployment, we're steady at 4.2%. We have crept up, so we're running back to November 2024 highs. But, Fed was saying 4.4, so we're pretty much in line. We probably have a little bit more that it will increase. We did see the impact of the federal jobs cuts kind of wane. So buried in there are some of those federal employees that were let go with 8 months of severance, and it's hard to tell if they all got new jobs or not, but it doesn't look like it had a sizable impact. A couple of other just Trump housing policies. This is a really weird one, and I'll keep this one milk and cookies. But there's a proposal by Scott Bissett on the supplementary leverage ratio, and in 2008 they put some rules in the banking crisis legislation that had a calculation for tier one assets and how much the bank needed to maintain in tier one assets, and U.S. Treasuries got included in that. The administration recognizes that if they adjust this ratio and take Treasuries out of that, it's going to encourage financial institutions to buy the 10-year Treasury, and that would send prices up, and that would send yields down, and that would be very, very positive for the housing market. So again, this is a little bit of a backdoor way to rough the Fed. It was said that it was going to go in effect in summer, so we don't have any guidance on when this is going to be. But I'm going to watch this closely, because this really could help our mortgage rate environment. And if we saw, even a 0.5% increase in the 10-year Treasury, and we saw a 0.5% decrease in the spreads, we could see interest rates a point lower. So it's going to be interesting. One other thing that is kind of a conversation that's out there in the public domain is Trump did announce that he has plans to privatize Fannie Mae and Freddie Mac, and these two entities, known as GSEs, they've been in conservatorship since 2008. The government kind of took back over it. A little bit of a controversial policy on both sides. There is some really sound reasons why privatizing it again would be positive for the housing industry. On the other hand, currently all of the excess interest they're making on those loans are going back into the Treasury. So this is a money maker for the government right now. And I'd rather make money this way than making money on my taxes. That's just my attitude, but that's me. So I've left this in because I know that we have new faces on here, but when we really look at where we are in the marketplace and the challenges that we really have an affordability issue more than anything else. And if we look at the fact that we've just seen appreciation significantly outpacing wage growth mixed with higher interest rates, it's just the affordability is the cap that's causing us to sit in this stagnant state. And so when we look back the last 5 years, the average appreciation of U.S. homes went up 41% in that period of time, but real wage growth only went up 14%. And when we couple that with the rates, and again, this is a great one to have in your listing presentations for your sellers. This shows each year the monthly principal and interest payment at the prevailing rate based on the median sales price. You'll notice that between 2021 and 2024, the monthly principal and interest went up 72%. And of course, in Florida, we also are dealing with property tax increases. We are also dealing with very large insurance cost increases. So Florida, I don't have the statistic. I could probably go and do a little bit of research and find that. But just for the average homeowner, it's a 72% increase before taxes and insurance. And the affordability factor, it takes 46% more income for that borrower to qualify. And so that's where you just have so many consumers that they can't afford to move in this market. And when rates come down and that affordability comes back, hey, they can move. And that's where we're going to see those 3 years of 1.2 to 1.7 million home sales that should have happened. I kind of liken it to a kinked hose. The hose is kinked, and when it unkinks, all those transactions are going to come shooting out. So let's look a little bit at the national housing market and see where things are in the United States. So currently, U.S. still has a slight seller advantage. 37 is the market action index. Anything over 30 is advantage seller. Anything under 30 is advantage buyer. I'm going to compare last month to this month because there's some interesting changes. And this is the same side view as the last slide. Median list price in the U.S. is sitting at $465,000. It's up from $450 last month. Median price of a new listing, $455, also an increase over last month. Price per square foot increasing as well. Average days on the market, we're in that spring selling season nationally, so we've seen that come down from 107 to 102 days. Median days 49, also coming down. Price decreases. We're going to talk a little bit about this in a latter slide, but typically in any given market, 34% of a market taking a price increase is considered to be average and typical. So we're at 38%. We were at 36% last year. That's an indicator some of those new listings that came on the market in the spring, they're starting to take that first price reduction. That's actually pretty healthy. Price increases 2%. A lot of times those are builders adding upgrades into the numbers. Relisted, 9% of the homes hitting the market are relisted. And the U.S. inventory, we're sitting at 787,000. That's actually up 9.4% over last month, and last month was up 9.7%. So that's a pretty sizable increase in the last 2 months. Now we're going to talk in a moment about what that means and why that actually is not a bad thing. If we take a look at the condo market, the average condo price, median list price is $389. We're still seller's advantage in the condo market. You will see inventory is rising substantially. And when we look at this side by side, we're looking at $389 for the median price. Average days on the market, 120, coming down from the highs of last year. Median days on the market, 70. The inventory continues to rise in the condo market also, so 229,000. That's up 4.9% over last month. And the last month, we were up 9.6%. So that's an indicator that we've got a lot of that spring inventory coming on the market and sellers are coming in. Now, this is the national inventory number, the line graph. We had a low of 240,000 available resale units in March of 2022, and that was a savagely unhealthy level to be at. When we look at historically, we typically will see for existing homes, we'll see somewhere between 1.2 and 1.4 million homes on the market at any given time in the U.S. So that was not even 20%, that's like 15% of a healthy market. And that's where we saw the crazy run up. We saw multiple offers. We just really had supply shock in pricing and in demand. So we're starting to return to a more healthy level. This, even though it feels like inventory is starting to squirt out our ears, this is actually a good thing. It gives consumers more choice, and it sets us up that when rates do drop, we're going to see more listings coming to the market. about 82% of all buyers bring a home to the market. And so that means that we actually would be in a position where we could still see inventory increase even as sales pick up. And that's what will create that healthy cycle. Look at average days on the market. Currently in the US, it's taking about 101 days on average, up from the low in July of 2022 of 54 days. So we're getting in that 3 to 4 month time frame on average. And if we look at price decreases, again, we talked about 34%. We're sitting at 37, and we're in pretty good shape. That's not bad in the US. Relists are coming down. You see a lot of those that were last fall's listings that got relisted in the spring, and now they're either selling or sitting on the market. If we break the US market down into the 4 tranches, so the red line is the bottom 25%, the gold is the next 25, the green is the next 25, and the blue is the upper 25%. You can see those median list prices, bottom 25% has been running about 223. Next year, 373. That third tier, about 560, and then that upper tier, 1.1 million. And you just kind of see how the different seasonalities impact each price point. And you notice that when you get in that spring market, particularly those upper 2 levels, you see more price acceleration and sellers getting a little bit ahead of the market, sometimes getting their price, sometimes not. But you notice that the bottom 2, the bottom 50% has a lot less of that trend. Now, if we bring this down into Florida, and we look at what's going on in our great state of Florida, right now, across the state, we're sitting at a seller's advantage. Market action index is 32. And if we just kind of compare this to last month, currently in Florida, the median list price is $507,000. Median price of a new listing is $465,000. Price per square foot's still $262. We're kind of a little bit up and down on that. Average days on the market is rising at 121 days. When we look at price decreases, this is where the Florida market is a little bit different than the national market. Currently, we're sitting in 1 out of 2 residential single-family resales have had a price reduction in this last 30-day period. So we're sitting at a pretty high level. Inventory in the state is just a little over almost 106,000, and of course, monthly median rent is running 2,700, and that's still a very high number relative to the US, which was about 2,200. When we look at the condo market is a little bit of a tale of 2 stories here. Median list price has been remaining very, very flat, 350,000. Median price of new listing, 339. That's also been down and flat. Price per square foot has fallen a little bit, 278. And you've got about 43% of condos have taken a price reduction in the state of Florida. Total inventory in the condo market, 74,388. The median rent in a condo is 2,300. So I did look at this. We talked about this last month. Florida represents a disproportionately high number of the listings and the inventory that's available. But I did some math this month to give you a little bit of better context. So Florida has 13.2% of all existing homes in the US. And in fact, I'm gonna go to this next slide. No, I might not have put that in here. Yeah, I did. Great. I'll put this in here. So in Florida, our total existing condo inventory is a little over 74,000 units. So we've got 74,000 condominiums in the state. Our US condo inventory is about 229. I did not put this in here. I apologize. Let me go back to this slide. So Florida has 13.2% of all existing home sales and 20.2% of all existing condos. And I apologize. This is the slide that I was trying to read from. So in Florida, the total existing homes if we added up every single family existing home in Florida, we'd have a little over 10 million that we would count up. That's 13.2% of the entire US. It's about 133 million. The condos are a little over 1.5 million. And I got some varying numbers on this. So I averaged it to 1.5, which is 20.2% of the entire US inventory. And part of the reason I wanted to look at this month is we've seen the total inventory for housing and for condos and single families running 35% of all US inventory. And as I got to thinking about that, I thought, well, how do we compare in housing stock? Is that disproportionate or not? So when we looked at this, the total existing condos is about 20.2%, and the single family is about 13%. So where there's 50 states, we actually disproportionately have a larger pool of housing compared to other markets. And yet, when we look at how much single family and condo inventory is available in Florida right now, it's about 180, almost 181,000 units, a little over 180. In the US, if we add up all the single family and the condos, we're sitting at a little over 1 million. By the way, this is the first time since 2019 or 2020 that we've been over this 1 million mark. So this is a kind of a bellwether statistic. So Florida has 17.7% of the total US inventory, down from 19.5% last month. And when I looked at this in a different way, we have 6.4% of the population, 13.2% of the existing homes. So we have more inventory on the market, but it doesn't look as bad as it could have if you just averaged every state's inventory. So that was my aha on this. And so currently we've got 32.3% of the total US condo inventory on the market. So 1 out of 3 condos available for sale in the US is in Florida, and 2 out of 10 or 1 out of 5 is Florida has 20.2% of all condo units. Yeah, there we go. So there's your numbers. So let's dive down into the local markets. Then we're going to provide a little bit of interpretation for you on this so that you can understand how to read these tea leaves. So if we look at Sarasota, we are sitting at 30. So we're in a very balanced market, although we're starting to see signs that we may tip into that buyer market territory very soon. And let's see, if we look at just these trends, 549 median list price, average days on the market, Sarasota County, 124 days. We're sitting at 57% price reduction, so a very high level of price reductions. And currently we're at 4,282 available single family resales. Now, it's important to note, Altos Research, where this data comes from, they track every home for sale in the US every single day. They do back out, and you'll see that there's some deviations between the Altos data, the National Association of Realtors data, and then your local MLS data. They back out any home that isn't actually truly available to be purchased. And so they do back out if it's a new construction build, but the new construction build is out 6 months or 8 months. They look at that and they say that's not really a unit that can go under contract today and actually transact in the next 30, 60 days. So they back that data out. So you're going to see a little bit of that data when you see total inventory numbers. If you see something different, that's why. Relisted, we're seeing about 4% of the market on the relist or back on the market. When we look at the condo market, Sarasota County, 397 median list price, we are into buyer's advantage territory. So the condo market is definitely softening a little bit. Average days on the market, 121 days. We are at 51%. So 1 out of 2 have taken a price reduction, and inventory in condos in Sarasota is about 2,400 units. If we look at that inventory, we're up from that extreme low in March of 2022 of 328, and you're seeing that inventory build. Again, this is a challenge for sellers because you've got more competition. For buyers, it means more opportunities, more negotiating power. And I will say that, while we wish that things would accelerate faster, and I'm in that camp just like the rest of you guys, this return to a healthier level of inventory is not a bad thing. This is a wound healing. And when we get to the other side, we're going to be in a lot better shape as a result of it. So there will be long-term gain from this short-term pain. When we look at average days on the market, you can see it's still increasing a little bit, 124, up from a low of 37 in Sarasota County. Median list price, January of 21, we were at 409. We hit the high in March of 2022 of almost 700,000, and we're currently sitting at 549. Now, I did look at a whole bunch of data and I'll have some commentary on this. It's not that we're going backwards specifically in pricing. In other words, it's not that homes are losing value. It's just that that crazy run up of we can ask any price, any buyer will pay it. That has just subsided. And I'm watching that closely every month to see if anything actually looks like really true price depreciation. There is one county, and I forget the name of the county. There's one county in Florida that I know was experiencing that. And there is some areas of Tampa that are starting to see some 0.5%, 1% decreases. But for all the Tri-County area that I look at here, we're still looking pretty healthy. We look at median list price by the 4 tranches. You can see lower tier 325 all the way up to the upper tier at 1.6 million. And you get a sense of that price volatility in the upper half of the market through some of those crazy times. Price decreases continue to rise in Sarasota County, 57% on average. Long-term average is obviously 34. In March 2022, we had that low of 13%. This is an interesting one. I broke this out in the market segments. All the segments are following about the same trends in terms of price decreases. So there really isn't one market being hit disproportionately, high end, low end. It's pretty much across the market, across the entire market that we're seeing those price reductions. If we move down to good old Charlotte County, we are in the advantage buyer range, not by much, but market action index is 29. Median list price in Charlotte County is 425. Median price of a new listing is 400. So sellers are getting aggressive at pricing below the existing inventory, and that's a good strategy for a seller. Average days on the market continues to increase to 146. Again, we're seeing that mid 50s for price decreases, and inventory is sitting about 3,490 total available units. We look at the condo market, we're sitting at 275 for an average median list price. Median price of a new listing, 244. That's a pretty significant difference. 52% of homes have taken a price reduction, and this is where we're seeing that average days on the market at a high level of about 156. And that's part of the reason that you see this buyer's advantage. When you see 156 days on the market, that's an extended marketing time. And that means that buyers are definitely going to be taking advantage of that. You look at Charlotte County as a whole, inventory, we're sitting at 3,490. You can see that trend. It follows very similar to the national and the other counties that we're looking at. When you think about having had only 282 available units back in June of 2021, that's just a staggering number. So we're more than 10 times that at this point. So a return to a healthy market. Average days on the market, you can see the trends here up from that low in June of 2022 of 39 days. And again, these are slides that I would really print out, and I would put these into your listing presentation so that you have those as a part of it. I think that's part of the reason we do this, is to equip you with that data to talk to your buyers and your sellers. Median list price going into that 2020 period or that 2021 period, we were sitting at 274. We had a high of 529 in Charlotte County, and then today our median list price is running about 425. Again, very similar trends, although you don't see the Charlotte County having as much seasonality in their upper end market than you do in Sarasota County. You can see that during COVID and the crazy run up, we had some price volatility here, but generally speaking, it's pretty consistent. So your upper level in Charlotte is a little lower price point at 800. Your bottom 25% is median is 279. We take a look at price decreases again, much like Sarasota County, you really don't see a lot of deviation between the different tranches, between the 4 different levels of inventory. So everything's running in that 50 to 60% has taken a price reduction in Charlotte. And if we pop back up to Manatee, of course, we've got a lot of new construction and a lot of other things happening in Manatee County. So median list price is $599, median price of a new listing $560. Average dollar per square foot, it's running $286. But we do have 57% of the market has taken a price decrease. And if we look at this from the condo market, We are still in buyer's advantage territory on the condo market. Median list price has continued to fall, 314.9. Median price of new listing, 325, and 228 is our average price per square foot. Price decreases, again, following that same trend. 1 out of 2 homes has seen a price decrease, and we currently have about 1,500 available units in Manatee County in the condo market. So if we look at the trends, inventory trends, we're at about 2,800 available inventory currently, up from the 268 low in 2022. Average days on the market, you can kind of see that trend just continues to gradually increase, sitting at 109 days, but substantially lower than some of the other counties, particularly Charlotte. Median list price. See the pricing trends here. We hit that high April 15th of 2022 of 857,000. That's just kind of staggering. Currently sitting at 599, as I said. And then properties with price decreases, you can kind of see we took a little bit of a dip with price reductions at the end of the year, and now we are back on the increase as we've exited season. People are getting a little more antsy to get stuff moved. We break this down into the tranches. You do see a little bit more price reductions in the bottom 25%. You're at 61% compared to the top 90, the top 25% at 47%. Could be that could be the impact of new construction on that top end. I'm not sure. I'd have to kind of dig into that, but that's a little bit of an interesting difference there. So if we take this data, what do we do with this, and how do we interpret this? If we look at this, I did show this last month. I did not have an opportunity to update this slide for this month. However, you'll see that not much had changed. I think this is going to be a good one to have in your listing presentation for a couple months. If a home seller prices their home right at the beginning, on average across our Tri-County area, it's taking 24 days to sell. Now, our average number of days was a lot higher than 24, and that's because we have a lot of homes that are overpricing, and those overpricing are causing that days on the market to look high when you look at the entire market. So if they price it right and they never have to take a price reduction, they're selling for an average of 95% of the sales price in 24 days. Conversely, if they have to do 1 or more price reductions, it's taking 120 days, and they're ultimately getting less money than they were getting if they just priced it right. So a seller's getting about 94.8% of their list price if they have to take more than 1 price reduction. So they're tracking that the new price compared to what they get. So buyers are just negotiating. If it's on the market longer, buyers are negotiating a better price. And I think that this is a great tool to say to a seller, hey, we need to price it right from day one, because if we do, we will get the right price and we will get you moved on faster. By the way, what you lose on the sell side, you'll make up on the buy side. And you marry the house, you date the rate. So when rates fall, you can refinance and bring down that housing cost. So it's really a good time to be a seller and a move up buyer in this market if you look at it from that perspective. What are some talking points? Let's talk about talking points. And Wayne, I see your hand up. So would you like to ask a question?
Yes, I would. Brian, could you go back to that slide? Love that slide. The only question I have, because that selling price, listing price, the listing price could change the week before, so there's not a big difference. You don't happen to have the original list to selling price, do you?
I would have that in the data. Yes, I would have that in the
I think
data.
that what I'm finding right now, that's about a 13% drop overall.
Okay.
So I think that's going to
I would not
exaggerate.
be surprised.
Yeah. So I think when I pull that up, I took original to selling because it gives you more indication of what's really happening. And I think in your chart, if you had that 1 price or more changes, I think that percentage would really be different. I think it'd be at least,
Yeah,
like
yeah,
90%.
you are correct, and I do have that. In fact, I know that that's in my stack of prep, so I will include that in the when I send out the slide deck. I will include that for you guys so that you have it. One point of clarification: the 94.8 is after they've taken the price reduction. That's actually at the final price, the percentage negotiated. But you're saying from the original price to the final price. Yep, I will get you that. I do have that data available, so thank you on that. Great question. Great input. So let's talk about how do we interpret this for your buyers and for your sellers. So as it relates to pricing pressure and just the buyer perception of the market, we've got tariffs, we've got all these things, everything's happening. When I took all the data and I ran it through my model, what it showed me very clearly is prices are not crashing. They are just normalizing. We're just going back to a normal market dynamic, a normal amount of time to sell, a normal amount of inventory, a normal amount of buyers in the market. Last year's overpricing has just given way to realistic listing behavior as buyers push back against inflated values in a higher interest rate environment. And this is where I was really looking to see, are prices falling, or is it just we're more realistic? And right now we're still just in the more realistic camp. As it relates to supply and demand shifts, inventory is rising, yes, but buyer activity is not quite increased to match it, which means more options and negotiating power for buyers, but strategic pricing is essential for the seller to compete. So we've got to capture the eye of that buyer. We've got to do it quickly. So those are those two. Days on the market and inventory absorption rates. Homes are taking longer to sell. That's not a surprise. And buyers have more to choose from. Sellers need to be aggressive with pricing and presentation to avoid sitting stale on the market. And I always say this: you can never underprice a home, because if you took a $500,000 home and you put it on the market for $400,000, guess what? You're gonna have a bidding war, and it probably will sell over $500,000. But if you take a $500,000 house, you put it on the market at $550,000, it becomes market stale very quickly. And of course, we all know that the buyers drive by it and they go, man, there must be something wrong with that house. Otherwise someone would have bought it. It looks like a nice place. And that's when we chase the market down. That's what Wayne was talking about. And we end up having this wide gap between our list price and our sales price. So don't be the pinball listing is the message there. When we look at cumulative days on the market and just buyer behavior, buyers are leveraging patience. They're using time as a negotiation tool. Old listings are back in play, but at discounted prices. So this is why you don't want to become that market stale listing. And if we talk about what does this all mean for your buyers, more inventory, longer days on the market means more choices and just better negotiating power. And if I was a buyer in this market right now, I would be asking sellers to do 2-1 buy downs, 3-2-1 buy downs, permanent rate buy downs. I'd be negotiating that into the purchase, because you can actually take advantage of those lower rates. You still have to qualify at the higher rate, but you can take advantage of those lower rates. And that also helps your seller compete with builders who are offering rates in the high 5s, low 6s right now, because they can buy the rate down. They've got the buying power and the mortgage tools to be able to do that. Where interest rates remain elevated, price reductions may offset some affordability strain. So again, you can negotiate the price down, pay the higher price on the rate now and refinance down the road. And then watch for stale listings with motivated sellers. We're back in that market where there are people that need to move, and they might be willing to take a loss just to get through the pain of moving. In summary, and this is just a kind of a where we are right now as we start to roll into we're coming up on half the year at the end of next month. We're just rebalancing the marketplace. Prices are adjusting, inventory is growing, buyers are re-entering more cautiously, and it's no longer a race. It's more of just a long-term negotiation. So I think overall, to really give you that summary, we're not in a bad market, and those rates, as we remain elevated in that 7 or that high 6, low 7 range, we're probably going to see continued slow growth of people moving back in. And there are some things that could trigger those spreads and could trigger those mortgage rates to come down a little bit. And if we can just get into those high 6s, we're off to the races. That's all we need. So we are very close. So with that said, I will send out a copy of the recording of this in case you want to go back and hear something. If I know I talk fast on these to try to get through everything. And I will also send out the information that Wayne asked about. And looks like Kennedy said, these are great for your seller presentation. I agree with that. So any questions, any ahas, any thoughts, feedbacks?
I think you're
Wayne?
spot on. I think you can negotiate some great deals as a buyer right now. There's a lot of opportunity. People are getting desperate, and it's fun.
Yeah, good. That's awesome. I agree. And let that be your message to your database. This is a great time to be sending messages out, sending texts out, doing equity updates, and just saying, hey, look, it's a good time to be in the market despite the higher rates. Leslie.
Yeah, it seems like, I mean, overall, the market from your statistics looks better than we feel like it is right here.
I don't disagree with that.
Yeah. And so there's really super hyper local pockets that are in terrible distress that are showing up way different than what those general statistics are doing. And
Yeah.
so on every single listing, you just have to break it down all the way down.
Yeah, I
really,
agree. I agree with you on that. Is there anything, where are you seeing that excess stress out in the market?
I'd say 34223, 34224. It's actually anywhere that we're working right now. Rotunda has so many listings. South Gulf Cove has so many listings. It's insane.
Yeah.
The inventory, it's extreme buyer's market, not just borderline buyer's
Yeah.
market.
And that's where we were seeing that market action index being 26, 27. And that does start to get that starts to get pretty deep into buyer market territory. I don't disagree with that. Yeah. And I think the important thing on that, and I'm so glad you brought that up. I think the important thing on that is when you're looking at taking your listings, it's really important to look at what are you currently competing with out there and what's recently sold. And sometimes you'll find a listing that there's 13 homes that you would compete with. And I always pull that based on if someone was going to look at my listing, what else would they have pulled from? Like, what else would they have looked at? You just kind of crawl into the shoes of the buyer. Other times you pull that up and there's like 54. And I've talked about this on previous calls, but during my sales years, I would always track every single week. I updated my listings on Tuesdays and my buyers on Thursdays. And we would always track how many week to week, how much competition was out there, how many new ones came on the market, and what were their pricing relative to what we thought our pricing should have been. And then what sold, because that's an indication what went pending. That's an indication where buyers decided to put their money. And you can look at that. You can look really good when you take the listing, and 3 weeks later, you realize we don't look so good.
Yeah, it's happened to us a lot. The other thing that we look at on a weekly basis is how many price reductions happened.
Exactly. Thank you. I missed that one. You're spot on. And in 2008 through 2010, maybe a little bit into 11, but 8 to 10, we would take our first 4 to 6 price reductions at the time of the listing. And this is a good time to be having those conversations with sellers that, hey, every 10 showings or 3 weeks to 30 days, the market is talking to us. We just have to be listening. And it's telling us that buyers are seeing value in other properties and we need to adjust to get there. So it's a good conversation. It's about setting the expectations up front. Wayne, you're on mute, sir.
2 other quick points. Back to your point, Leslie. It is interesting though. When I look at my numbers on Sarasota, I'm seeing a single family home, 5.5 months supply. That's neither here or there, but there are people inside of there that certainly want a deal. So that I find interesting. Your point on the discount rates. I track this every week. They've been running anywhere from 8 to 12% a week. So you're right. It justifies what Brian's saying. Half of them are being reduced within a month. But I do hit you right on the head that first 30 days are so important. And as a buyer rep, I just look at that as, I hate to say it, but blood in the water. They're out there 60, 80, 90 days. We can negotiate. So it is what you make of it, I think.
Yep. That's great. Great feedback, Wayne. Appreciate both of you guys on that. Great. Anything else for the good of the cause, guys? Give me a thumbs up with this valuable this month. Okay, good. I appreciate that. I always say this, the greatest gift you can give me is your time. So I appreciate you all being here. If you have questions, if there's a topic or anything that you want to see covered on a future call, let me know. And you watch for the dates. I believe it is the 17th that we're going to have our launch event. It's going to be a midday event with a nice food. It's going to be back where we had our awards banquet this last time. Kennedy, what was the name of that location? I forget.
Plantation Country Club.
Plantation Country Club, great. And then in the 2 days that follow up workshops, and I'm super excited that you get to meet our our new finance director that I know you guys are going to be excited about. So with that said, I will give you your day back. Thank you for your time. I realize we're a little over, so go make it a great day and go service your clients, your buyers, and your sellers at the highest level.
Hey, Brian, do you mind
Yes.
staying for a second?
Nope, you're great. I will do
Bye,
that.
everyone.
Thanks, everyone.
Okay.
Good job, Brian.
Thank you. Appreciate it.
See you, Kennedy.
Bye, Brad.
Stop the recording. There we go.